Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Marvell Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
The starting point has to be this massive pivot Marvell has made.
Right. They've completely changed their whole identity. They aren't the legacy storage company you might remember.
Not at all. It's all about this cloud-optimized strategy now. They've figured out that the real money isn't just in the AI processors, but in all the infrastructure that connects them.
Exactly. You can have the fastest engine in the world, but it's useless without the transmission and the axles. Marvell is building that critical infrastructure.
And you can really see that shift showing up in the numbers. The growth is, well, it's accelerating.
It really is. I mean, if you look at their Q3 fiscal 2026 results, they hit a record net revenue. We're talking $2.075 billion.
And the growth rate?
Up 37% year over year. For a company this size, that's just a huge number. And it's almost all coming from one place.
The data center.
The data center. That segment is the engine. In Q4 of 2025, revenue there shot up 78% year over year.
Okay, 78%. That's an explosive number.
Yeah.
But let me push back a bit. Aren't we seeing these kinds of figures across the AI sector? What makes Marvell's growth different, maybe more sustainable?
That's a fantastic point. The difference is what they're selling. It's connectivity and custom designs. These things are, they're non-negotiable.
Meaning if you're a hyperscaler and you're spending billions on new AI chips.
You have to spend on the infrastructure to connect them. There's no choice. And Marvell's custom designs get embedded so deeply into their architecture. That's why the data center segment is now, about 73% of their total revenue? It was $1.52 billion in the last quarter alone.
So the foundation is solid. What's the view looking forward? Is management expecting this to cool off?
The opposite, actually. They are exceptionally confident. Yeah. They're guiding for full-year fiscal 2026 revenue growth to be over 40%. But the really telling number is for fiscal 2027. They're still projecting data center growth of more than 25%.
That signals they already have visibility into future orders, right? This isn't just optimism.
Exactly. It means they have design wins and purchase orders already locked in.
Okay, so that's the top-line growth. But a big part of this story, as I see it, is about profitability. If you're selling these high-value custom parts, you should have pricing power.
You absolutely should. And it's showing up. This is where it gets really interesting for investors. Their gross margins are expanding.
How much?
Well, if you look at their non-GAAP gross margin, so stripping out some of the one-off costs, it just hit 59.7%.
Almost 60%.
Almost 60%. That is a huge sign of pricing power. It tells you that customers need their parts so badly they're willing to pay a premium.
And that should trickle down the income statement, right? As they scale up production of these winning chips, the efficiency gains should boost the net profit.
That's the thesis. Their operating income margin is already very healthy, 31.75%. But analysts see a clear path for their net profit margins to expand from where they are now, around 10%.
To what?
Toward 20% within a few years. If they can double their net profitability, the amount of free cash flow they'll generate would just be transformational.
A move to 20% net margin is huge. How are they funding the kind of strategic moves needed to get there?
Well, they've been very smart. They just generated $2.5 billion in cash by selling off their automotive Ethernet business.
A non-core asset.
Exactly. So they get this huge cash infusion, and it lets them do two massive things at once.
Which would be the Celestial AI acquisition and the big share buyback.
That's right. A $3.25 billion acquisition and a $5.0 billion share repurchase program. That buyback is a huge vote of confidence from management.
They're basically saying they believe their own stock is undervalued.
Precisely, and they're still paying their quarterly dividend. It's a real commitment to shareholder returns. And it's not just us noticing this, the institutions are.
How do you mean?
Moody's just upgraded their senior unsecured ratings to Ba2. Now, for anyone not deep in credit ratings, that's a big stamp of approval. It reflects trust in their financial stability and their technology portfolio.
So that financial strength is what lets them build this competitive moat we hear so much about.
What about the foundation for it? Absolutely.
Okay, let's unpack that moat. What is Marvell selling that someone like NVIDIA or Broadcom can't just come in and replicate easily?
The key is proprietary, custom silicon paired with software. They're focused on these really specialized physical layers of the data center.
Okay, you're going to have to break that down. You're talking about things like their Golden Cable Initiative and these Alaska PCIe 6 retimers. That's a lot of jargon.
Fair enough. Let's make it simple. PCIe 6 is just the newest, fastest standard for components inside a server to talk to each other.
Okay.
But at those incredible speeds, the signal gets weak really fast. A retimer is basically a tiny specialized signal booster. It cleans up and regenerates that signal so data can travel farther, faster, without errors.
So it's a component you can't do without in these massive high-speed AI servers.
It is non-negotiable, and that's the key. It creates immense switching costs. Once a hyperscaler designs your retimer into their multi-billion-dollar architecture, it is incredibly difficult and expensive to rip it out. That's lock-in.
And the Celestial AI acquisition for $3.25 billion, that just pours concrete on that moat.
It's a game changer. It puts them on the fast track for silicon photonics.
Using light to move data instead of electricity.
Exactly. It's the future for massive data transfer. It's faster, uses less power, generates less heat. Celestial AI gives them a critical edge in what will be a non-negotiable technology for the next generation of AI systems.
So that's the future bet. Is there any validation right now that the big players are buying into this roadmap?
Two huge validation points. First, they have a warrant deal with Amazon. That means Amazon isn't just a customer, they're a strategic partner betting on Marvell's roadmap.
And the second?
They have purchase orders that cover their entire full-year forecast for a major new XPU program at another huge cloud customer. That gives them incredible revenue visibility.
So it's not just one product, they're selling into the whole ecosystem.
Absolutely. They dominate in optical interconnects. The DSPs, the drivers, they expect their data center switch revenue alone to be over $500 million in fiscal 27. They're selling all the critical pieces.
All right, let's shift to the stock itself, because this is where the puzzle really emerges for me.
The disconnect.
The disconnect. You have surging growth, expanding margins, smart acquisitions, and the stock, year to date, is down more than 20%. What's going on?
Analysts see this as a classic case of what they call mean reversion. The market got hung up on old fears, maybe about cyclical spending, and hasn't caught up to the reality of how strong the business is now.
So the idea is that the stock price has to eventually revert or catch up to the strong fundamentals.
That's the theory. The business quality is high, the stock price has lagged, and that gap is expected to close.
So what are analysts saying the price should be?
The consensus price target is around $111.25. From recent levels, that's something like 28% upside. And you see some firms, like Stifel, with targets even higher, up at $114.
And who's buying? Are the big institutions getting in on this?
They are. Institutional ownership is already high, around 84%. But the recent 13F filings show active accumulation. Big players are building their positions.
Which suggests they see the same disconnect and are positioning before, the rest of the market catches on.
That's exactly what it suggests.
So from a technical standpoint, what's the trigger? What are people watching for?
The stock's been moving sideways for a bit, consolidating. We've already seen that positive news can cause these nice intraday pops, but the key level everyone is watching is $90. A clean, strong break above 90 is seen as the trigger that could bring in momentum buyers and start that move toward the $111, $114 range.
And it seems like we have a few potential catalysts on the horizon that could provide that spark.
We do. Several very specific, very near-term ones.
What's the most
immediate? The CEO, Matt Murphy, has a fireside chat at CES in January. The market will be listening very closely for updates on the Celestial AI integration and, crucially, for his take on hyperscaler spending trends.
Any positive news there could be an immediate trigger.
It could be. And then you have two major financial events. The closing of the Celestial AI deal is expected in the first quarter of 2026. And then you get the Q4 earnings in late February or early March.
Where they'll need to confirm that 40% plus growth guidance.
That's the one. Confirmation there will be absolutely crucial for confidence.
Okay, we have to balance this out. What are the risks? What's the main bear case here?
The primary risk, and it's a real one, is customer concentration.
They rely too much on just a few giant customers.
Right. The hyperscalers. And while their spending seems unstoppable now, it can be cyclical. If there's a surprise slowdown in their capital spending, it could definitely compress Marvell's growth below that 25% they're guiding for in fiscal 27.
How is that risk being mitigated?
Well, many think that management's forecast is already on the conservative side, and the Celestial AI acquisition helps a lot. It diversifies their product portfolio so they're less exposed to any single customer or a single product's life cycle.
What about internal risks? Execution. Getting to that 20% net margin goal is ambitious.
It is. There's definite execution risk. Integrating a $3 billion+ deal is never simple, and they face tough competition on pricing. It could definitely delay that margin goal.
But their current performance suggests they're managing things pretty well.
Extremely well. I mean, we talked about the nearly 60% non-GAAP gross margin. And another key metric is their return on capital, which is over 15%.
In simple terms.
For every dollar they invest back into the business, they're generating 15 cents in profit. That shows incredibly efficient management and smart R&D spending. It suggests they have the chops to handle the integration.
So, to sum it up, Marvell has repositioned itself as a provider of really non-negotiable infrastructure for AI. The growth is accelerating, they're buying back tons of stock, and there are multiple catalysts just around the corner.
And all that suggests that this valuation disconnect, this 20% lag in the stock, might not last for much longer.
It's a compelling story of critical infrastructure.
Remember to subscribe and follow our talks so you don't miss our analysis on other key market players.